Just to start off, if you start at age 16 and invest $10 a week into stocks, they can have a percent. By the time of your retirement, you'll have about $36 million. Now think to yourself, what would you do with this money?
You guys can put some ideas in the chat if you want. Okay, I got some great responses, like maybe investing into more stocks, maybe giving it to your grandchildren for college or something, investing in real estate.
So, just to start off, we're going to go over why investing is so important. First of all, the main reason why people uh, discuss the importance of investing is because savings tend to lose money over time just because of inflation and the rising cost of living. So, the way you could kind of think about it is that if you have savings separated out, but the whole world is just getting more and more expensive, well, because of that, your savings are going to lose purchasing power. And so they're just going to be losing money over time. And that's your hard earned money, which is why people talk about investing so much so that at least you're not losing some of the money that you work so hard to earn. Um, Here's a graph that depicts kind of inflation over the last 40 years. And as you can see, life got almost four times more expensive over the course of these 40 years. So that just highlights that inflation is very, very real and it's very much, like a reality of your life. And so it's important to kind of at least be cognizant of it and then, um, you know, make sure that you acknowledge it so that you don't lose money over time. The second major benefit of starting early with investing is taking advantage of compounding. So I don't have a visual on the slide because we went over it last workshop, but compounding is exponential growth. And as you guys can imagine, it really, really comes into play maybe like a couple years down the line where you can really, really take advantage of that exponential growth. And so that's why it's really important to start early, especially because if you're going to utilize compounding, maybe to save for like retirement or things like that, if you start early, that really, really like those 5, 10 years can make the world of a difference. So, yeah, that's why investing is important. And it's important that you guys start thinking about it. Just to start off, we're going to go over the basics of investing. So, firstly, what is a mutual fund or an ETF? So a mutual fund is basically like a company or a fund that pools money from all of these different investors. So basically, you and your neighbor and all these other people can just put money into this fund, and it sort of purchases all kinds of different securities for you, being like stocks, bonds, and stuff like that. And so, because it's already kind of diversified, which is something we'll be going into, it's considered to be relatively safe, and also because a lot of the time they're managed by professionals that buy these stocks and bonds across different industries, and so that's why it's considered relatively safe. A second option is just investing in stocks. And a stock is essentially equity in a company because you're purchasing like a fraction of the company every time you buy it. Like maybe a company has 100 stocks and you might purchase one stock, and that'll make you an owner of one or like 1% of the company. And so stocks can both be safe and be risky. If you invest in a very big corporation like Apple or Microsoft or something like that, you won't, they're not very volatile stocks. And so they're fairly safe. But also your returns or your ROI might not be very, very high because they are pretty safe stocks. Whereas other, like maybe emerging tech companies, may be very, very volatile because technology is still being debated and things like that. But they also might have the possibility for a very, very high return later on. So stocks, the risk level of stocks really depends on the stock itself. And then finally, what is a bond? So a bond represents a loan made by an investor to a borrower. And so there's typically three types of bonds, which we'll get into later on. And they all have different risk levels, which we'll also address later on. But there's usually like federal bonds for the US government. There's also bonds for like all types of other, the governments of other companies or other countries. But we have the US government. We also have munis or municipal bonds, which would just be like city governments. And then finally, you also have corporate bonds, which is just to companies. And we'll get into more how bonds work later on.
Okay, so how do mutual funds work? Like Rithika mentioned, essentially your money is being pooled and managed by a professional, so they're creating that portfolio for you. So there's many different types of mutual funds. Like for example, index fund is usually like the most common. And then the pros of mutual fund is essentially that they're really diverse. So for example, your investments are being spread off across like maybe different sectors or different like stocks or different types of investments. And because of this, well, we'll get into diversification, but because of this, your investments are really diverse. So let's say, for example, like one of the stocks or one of the investments as part of that mutual fund like isn't doing so well. Well, hopefully like the rest are doing well. So it'll kind of like cancel out that loss of that one. So, but a con can be that there can be a management or distribution fee just because you're having somebody manage this fund for you.
Okay, so there's three ways to sort of earn money through a mutual fund, and these three same methods kind of apply to securities overall. So firstly, you have the possibility of dividend payments. So dividends are a distribution of a company's earnings to its shareholders, and it definitely varies based on the company's board of directors. So some have a lot of dividends and are known for that, whereas others don't do dividends at all, and it might be in the form of cash or stock. So just to like overview, what happens is that maybe a company has really good earnings for like a quarter or a year or something like that. And so they kind of want to pay it back to their shareholders because those are people that, you know, invested in the company. And so they kind of decide that maybe you have one stock and there's 100 stocks in the company. And so maybe they decide that for every shareholder, which, you know, you would be a shareholder if you hold like one, you know, share of the company, they'll decide that we want to give back like maybe 0.1% of our earnings per share to like each shareholder or something like that. And it definitely varies based on the company. And so some people usually dividends payments happen for very large corporations that aren't so volatile. And so a lot of people, because they only want to play it safe, they only chase really dividend payments. So they find a big safe company and they do research into what the dividend payments look like, and they'll buy, you know, like from a company that has very high dividend payments. Another option is capital gains distributions. And so that's the profit that returns from an increase in value when the investors sell the shares of their fund. And so that basically means that maybe you bought it for $10 and 5 years later it's worth $15. So now you're selling it at that 15 and you're making $5. And then the same would apply for shorts as well as investments, but that's something we'll get into later on. And then finally, increased net asset values. So that's just when the whole value of the mutual fund share increases. It's very similar to capital gains distributions, but it's when you haven't really sold your security yet.
To touch on like the return on investment that one will usually receive from a mutual fund, it's about 7-ish%. This is just like from the past 5 years, looking at an average. Another calculation that might be helpful for you when deciding, oh, what is my like return on investment going to be, is a rule of 72. So this is essentially if you're trying to figure out how long it takes for you to double your money. So the amount of years it takes for you to double your money is 72 divided by the interest rate, like the interest rate of growth. So for example, here 6.92 as a percentage. So for example, for mutual funds on average, it will take you a little over 10 years to double your money with a mutual fund. And so just putting that to perspective, like if you put 10K into a mutual fund right now, in 10 years, you'll have about 20K.
like we said, considered relatively safe, but you have to do your research. We're now going to get into stocks. So a stock is a fractional ownership of a company, and when you buy a stock or you buy a share, you're buying a fraction of the company. And so because of that, you become a part owner of the business along with the other shareholders. And so, for instance, maybe there's 100 shares available on the market, and you buy one, then you automatically own 1% of the company already. So that's kind of how stocks work. And like we discussed already, they tend to vary in maybe their degrees of volatility and all of that.
Okay, so ways to earn money through stocks. This is pretty similar to the mutual fund. So first we have dividend payments, like which is what Ratika talked about, is distribution of companies' distribution earnings to its shareholders. Then we also have net increased value. So for example, if the company goes up, like the value of that company goes up as a result, the value of the stock increases. And then also we have straight shorting or buying, and you can make money off of that.
Yeah, so just to really quickly go over this, when you buy a stock, like I said, you're kind of purchasing a fraction of the company. And so you want the value of the company to increase so that maybe your stock, maybe your fraction of the company that you own was worth $10 before, but because the company got more successful, it's worth 15 now. And so you're kind of buying stake into the company. But the opposite is shorting, where you're actually betting that the company is going to lose value. So maybe you're buying it, you're buying your stock or your share for $10 and you're shorting it, which means that you're actually hoping the value of the company will go down, and then you'll make money by the company, like the value of the company decreasing. So shorting and buying are kind of opposites, and so it's important that you consider which way you think that the company is going to go when you buy a share. Also to cover investor ROI. So there's almost an 18% stock return over the last 5 years. On an annual basis, I can tell you that usually the average annual returns from stocks is about 8%. And so going off that 8% number, it would take you approximately 9 years to double your money with the rule of 72 that Linda already talked about. And then with this 18%, it's about 5 years to double your money. So just keep that in mind when you think about calculating your returns.
And just adding on to that, that 18% was based on the S&P 500, which is like a stock market index that measures the performance of the 500 like top performing US companies across 11 sectors. Okay, so now we'll go get a little bit into some things to consider when evaluating stocks. Like, how do you know that, oh, this is going to be a good investment or maybe it's a bad investment and you want to short it? So first we have the PE ratio. So the price to earnings ratio is a valuation metric used to assess the relative value of a company's stock by comparing its current share price to its earnings per share price, which is like the EPS ratio. So essentially how this is calculated by dividing the current market price of the stock, like how much it's being sold for right now, by its earnings per share. So the PE ratio can provide you with some insights into how much investors are willing to pay for each dollar of earnings generated by a said company. So a higher PE ratio typically indicates that the investors are willing to pay more for the company's earnings. So this could be maybe because they expect it to have like a high growth in the future. They have a lot of hope in that company that it's going to go up. Or maybe they also perceive it as less of a risk. So what constitute a good PE ratio? So this really varies across sector. For example, a PE ratio of 10 could be considered normal for some utility sectors, even though it could be considered extremely low for maybe like a company that's in the tech sector. So that's why it's important to always compare the PE ratios with other companies within the same industry, just to kind of like gauge, oh, is this high for my industry or maybe is this low? So when comparing a PE ratio to the market average or its competitors, a stock with a lower PE ratio is generally good, but not too low. So essentially, this is because you're spending less money for each dollar of a company, for each dollar of a company's earnings. So, like I said, that means that you're paying less money per the earnings. So, but also you also have to be careful to watch that it's not extremely low, like maybe below 5 or something, because that could mean that it is extremely risky or investors see it as a risky investment and they don't and they don't believe that the stock value is going to go up. They think it's just going to stay the same. So that's why people are not like purchasing it. And then we also have the price to sales ratio, which tells us how much investors are willing to pay per dollar of a company's sales. So this is essentially calculated by dividing the market capitalization by the company's sales for the past 12 months. And what market capitalization is, it's the total value of a company's shares of stock that it has like outstanding. So this is calculated by multiplying the price of a stock by its total number of shares outstanding. So typically, a PS ratio ranging from 1 to 2 is considered good, but like I said, we also have to cross-check and evaluate it with its competitors or similar companies within that industry. So a higher PS ratio may indicate that a company is not effectively using their investors' fund to drive revenue. When comparing similar companies across industries, lower PS ratios are generally more favorable. And then additionally, to evaluate stocks, especially as a beginner, I recommend using maybe like a platform like Yahoo Finance and evaluating and seeing what other investors are doing and what they are recommending. This can be a great resource for beginners. For example, we can look at recommendations for either buying or shorting. We can also look at investors' evaluation of the stock. Maybe they think it's overvalued, undervalued, and they usually show a pretty accurate chart that predicts, oh, the short-term and long-term investments. Other factors that are really important to consider are dividends, like we talked about, dividend payments. The dividends are payments made by its by the corporation to its shareholders as a distribution of its profits. So these are typically paid on a yearly or quarterly basis. So yeah, when considering some stocks you want to buy, you might want to consider where the company pays dividends. And also you might want to consider its historical dividend growth, like, oh, are the dividends that I'm receiving, are they going to increase? Um, so yeah, this is mostly just done by larger corporations' dividends. And then also a really important factor to consider is your own personal goals and how much risk you're willing to take on. So you want to make sure that you just align your investment decisions with your financial goals and also your risk tolerance. So you want to consider how the investment fits into your overall portfolio and whether you're comfortable taking on maybe like some fluctuations in the stock price. So for example, let's say your goal is to save up for college, maybe it's coming up in a couple of years, then it might want to invest in safer stocks to ensure that you're making a steady but reliable return on that investment to ensure that, oh, nothing bad's going to happen and maybe one of my stocks that I'm investing is going to go bankrupt and I will lose all my investments.
Okay. Okay, so now we're gonna go into bonds. So, the way to think about a bond is that you're essentially lending money to either, a government or a corporation. And so because you're giving them money now, they kind of have an obligation to pay you back more later down the line. And so there's typically a couple different time periods of bonds. You can choose something short term, like 1 year. You can also choose something longer, like 5 years or 10 years. And so there's usually different time intervals that you can choose from. And that basically is, when you're going to get your money kind of returned to you and you get paid back with more money. And so, usually the 1 year bonds are considered safer, so they might have lower returns than a 10 or 15 or even 20-year bond. And so it's important that you choose accordingly. And bonds differ in maybe their risk levels and their volatilities, but they are considered generally safe. So first of all, thinking about government bonds, just like to the American government, if the American government fails, the whole world economy would kind of collapse. And so because of that, bonds are considered highly, highly safe for the American government. And you can kind of like assume that 2 to 3% returns depending on the length. Um, we also talked about municipal bonds, which are as a government on maybe like a city level, and those are also pretty safe because they are also kind of a form of government bonds. And so, especially if you're maybe hesitant about investing, you're maybe unsure about research into stocks, bonds are almost considered fail safe in regards to maybe their risk. And so you might just choose to invest in a bond because it'll contrast that inflation, and it'll make sure that you're not losing any money, but they're still very, very safe. A final option is corporate bonds. So corporate bonds can also be very, very safe depending on the institution, and they might also stick to that 2 to 3% returns. However, there's also riskier options that maybe have 9 or even 10% returns, but they're considered way, way, way riskier. So how do you tell? Usually corporate bonds have a rating. It might be like A, triple A, double A, and then it'll go to B, C. And so triple A's are considered the best, and then B's and C's are considered the worst. So if you have a company that is rated triple A, which is the highest and the best, that means that they are that they have very good finances, and they are very likely to be able to pay you back. And that means that maybe your returns are only going to be 2 to 3%, but it's considered very, very safe. Whereas maybe a company with like a C rating gives you that really high return back, so that 9% even, but they're considered a little bit riskier because maybe the company won't be able to pay you back in the future. So those are kind of the considerations with bonds. And so, like I said, there's three different options, being the federal bonds, the American government bonds, munis, and then corporate bonds that have different risk levels. And so you can choose accordingly depending on your own comfort level. So now we're going to quickly get into how to manage your portfolio. Oh, so sorry. Some tips for managing your portfolio. The first one is diversification. So, like we talked about before, you might want, so for instance, thinking about bonds, you might buy super safe bonds with the American federal government, but you also might buy riskier corporate bonds. And so that's an example of diversification because you're spreading your risk. Usually with stocks, diversification is seen with buying stocks across different industries, because maybe there's a financial crisis and all the banks are failing, but all the tech companies are doing amazing, or something like that. Or maybe one particular, like maybe the oil industry is really, really down, but the tech industry is up, and so that'll help even you out. And so it's kind of this concept of not putting all your eggs in one basket, so that maybe if something goes wrong, you're still safe because of your other investments. So diversification is a really, really, really important strategy. A second important strategy is compounding or starting early. So even if you have something safe like 2% returns or something like that, if you think about the power of compounding and you start early, that can help you, kind of make a fortune or something like that for your retirement, which is, many, many years down the line. But if you do start early, you could take advantage of that compounding and that exponential slope. So maybe at the beginning, in the first 5 years, you're not making as much money, but when you hit that 15 or 20 or 25-year mark, your earnings are really, really, really going to increase. And so it's important that you start as early as you can. Now, regarding research, there's a couple of different places that you might go. Firstly, like Linda went over all those metrics, like your EPS, your PE ratios, your PS ratios. And so where you can find a lot of that information is on Yahoo Finance or an equivalent. So you might do like Google Stocks, you might choose Seeking Alpha. There's all of these platforms that kind of, highlight different financial metrics of a company. And so you might look at different websites to help you do your research. In general, you want to look into a company's, it's talking specifically about stocks and maybe corporate bonds. You want to look into their development, so their R&D, their research and development, their opportunities for growth. So, what's the market like? Is it a company like Microsoft that's very, very, very well established, or is it maybe an up and coming tech company that might have the possibility for more volatility? So you want to think about the market and their opportunities for growth and how comfortable you feel. And also use your interest to your advantage. So maybe you're very, very familiar with video games or something like that. And so you understand the councils, you understand how everything works. And so maybe you're better at investing in something like, Activision, versus maybe instead you're really, really interested in a different sector. And so you can, because you're interested in it, you have a sort of advantage because you understand the market, you understand opportunities for growth, you understand maybe what might be successful and what might not be successful. And so definitely consider your interests as a way to maybe start your investments because what you're interested in will definitely lend you an advantage later on. Here's a really quick graph. It's just a screenshot from Yahoo Finance. And here we just wanted to show you how you can kind of see maybe a company. So here we have Tesla as an example. You can kind of see maybe their trends, how they're doing. Tesla is known to be a very, very volatile stock. And so you could also see what investors are saying. So if you look towards the center and maybe left of your screen towards the top, you'll see their short-term, midterm, and long-term predictions from analysts. And of course, you can choose to agree with them or disagree with them. The market is just a product of different, interpretations of information. And so different investors across different websites might be saying different things. And so, do your research accordingly. But you can see what investors are saying on Yahoo. You can see their latest share prices. You can look at dates. So you can look at, I guess here it's 1 year. You can look at it across 5 years, 2 years, the last month. You can look at maybe how the stock fluctuates after their quarterly earnings are released, things like that. So this is just an example. You just go to yahoo.finance.com, you choose a company, and boom, you have all of these statistics for you to analyze later on.
And just some additional tips on how to get started. So maybe you want to get started through a company's 401k program, which we talked about before. It's basically an employer-sponsored retirement account. Also, since if you're younger, you might want to like start choosing some sort of account to use. Like for example, I use Fidelity, but maybe you want to use like Robinhood or Charles Schwab. And then identify your time horizon and risk tolerance, like we talked about, kind of like your goals. For example, like, oh, how much money you want to make in what period of time, and kind of like what your long-term goals are, or maybe if you have a short-term goal instead, you might want to invest in a stock that's more like volatile versus if you have a long-term goal that you want to make sure you achieve, you might want to invest in like maybe a very safe stock that you know is going to go up and you won't lose any of your money. Like we said, you might want to consider some of your personal interests just because you're very knowledgeable about this. And then also be aware of maybe some other finances you have. So maybe if you have different sources of income, or you want to allocate money towards your savings and emergency fund, just make sure that you're balancing your investments with all these other sources of finances that you may have. And then also maybe you can consider having a financial advisor, or also there are a lot of sites that maybe you pay a subscription to them and they'll post a lot of like articles or something like that. Or you can also consider just looking at a company's earnings report, because usually after an earnings report, the stock price will go up or down by a lot usually. So maybe you want to see what other investors are predicting, if the earnings reports are going to be good or higher than expected, higher than projected, then maybe the stock price will go up and you can make a lot of money from that.
Okay, so we did cover a lot of content. So here we're going to give you a second to maybe put any questions or any other topics you want us to address in the chat. Feel free to do it in the public chat or message us privately. Either is fine. But maybe just take a second to, go over what you understand and what you maybe want more clarification on.
Okay, we got a few questions. So the first one is, what is a stock index? So we briefly went over this, but didn't really get into much detail. So essentially, a stock index is a measure like of the performance of a group of stocks in a particular market or sector. So there's different types, like how we talked about. There's the S&P 500, the Dow Jones, and other that kind of like track how a group of stocks is progressing over time, just to kind of track like the market or.
I did get some other questions in the chat. So the first one was relating to what kind of investing minors can do, if it needs to be supervised and things like that. So it's great if you're a minor and you're thinking about investing. Usually, a lot of the time, you open an account and you could either use your money if you're already earning money, or maybe your parents are willing to give you some money. And a lot of youth kind of are oriented towards platforms like maybe Robinhood or things like that. And so you could just open an account. And sometimes you can do it like under your parents' name. You also might be able to do it under your name. But since you're using, like your parents' money, you'll have to put their name on, certain aspects of it. But other than that, you're pretty much free to do, depending on what your parents are comfortable with or what you're comfortable with, if it's your own money. You can pretty much pursue any kind of investments you want after that. You might want to, talk it over with your parents or things like that. But yeah, there aren't really other restrictions or anything like that after. And then a second question I saw is, if I invest in my hobby, should I also invest in other areas to diversify? So this definitely depends. The general answer is yes. So if you're maybe very interested in like biotech or something like that, and you're really, really passionate about the work of maybe these two companies, that's, great. But in maybe the circumstance that something happens where maybe the company's technology fails, or maybe competitors have like a better product that would maybe, bring your earnings down, and that's something that most people don't want to risk. And so I would suggest, yes, definitely pursuing your interests, maybe allocating more of your money into markets and topics that you understand versus what you don't. But then also, considering maybe other sectors just for like safety reasons. So maybe you'll buy some bonds, maybe you'll invest in other aspects of tech or banks, or things like that. And that diverse, and it doesn't have to be like so much of your money, it doesn't have to be most of your investments or anything like that, but it's just kind of a buffer so that if something does go wrong, you're still safe because you have other investments that are making money for you. So that's kind of the concept behind diversification.
Yeah, and then I also have another one, where can I find more information regarding analyzing stocks or bonds? So for stocks, like we mentioned, like the Monty Fool, maybe Yahoo Finance, that's what I use because with Yahoo Finance, usually if you like scroll down, there'll be a bunch of articles relating to that company, so you can kind of like see what other people are saying and seeing what numbers are having to back that up, maybe what their earnings report predictions are, and so on.
Yeah, and then just to add on to that, there's a lot of websites that just publish like stock analysis, and so maybe you're not really comfortable with some of the jargon or like terminology that they use, but even then, you might want to like look through different investor opinions. So you could see some of those on like Seeking Alpha. You could also pay for um, like investing advice and things like that. So that's an option as well. Finally, if you just go onto like the company's website, I'm using companies as an example, but if you just go on their website, you can look at their investor relations page. That'll have their, quarterly earnings. It'll also have, letters talking about what the company is moving into in the future and things like that. So definitely consider their investor relations page, and then also their PR page. So, for instance, there was a major deal very recently with Microsoft and Warren Buffett, and I want to say Activision, and there was, like a lot of discussion with their PR team and monopoly, and it was basically, it had to do with like the threat of a monopoly, and the United States government was, you know might have restricted the deal versus they might not have. Same thing with like European governments. And so all of that is like really important information to stay up to date with. You know, you want to know what kind of mergers and acquisitions maybe the company is doing. And so you can find all of those articles and all that information on the company's PR page, just on their website, and also just articles like Linda talked about. You might find them on Yahoo Finance. You might find them just across different, financial analysis platforms. But just to stay on top of maybe some of the news, is also some research that you should consider doing. Okay, if you have any other questions, feel free to email us or just reach out to us in any other way. We're happy to answer them. But for now, thank you guys all for coming. If you guys wanted some insight into our previous workshops relating to, budgeting, income management, how to file for taxes and get tax returns, all of that, the recordings of all of the workshops are posted on our YouTube. The link is right there. We would really appreciate if you guys, subscribed or watched our videos. And if you